ended March 2025 earnings press conference. We are joined today by our leadership, our MD and CEO, CVK, our CFO, Shiv Walia, and CPO, Ram Sundarajan. I'll hand it over to CVK for next comment.
Good evening to everyone here, and good afternoon, good evening to people joining from other time zones. Thank you for joining us today for HCLTech FY25 and the fourth quarter earnings announcement. FY25, we demonstrated resilience and growth supported by our diverse and all-weather portfolio despite the uncertainty in the global economy. I'm pleased to share that we've delivered superior growth with good control over steady profitability during challenging times. Our razor-sharp focus on clients during this period of uncertainty helped us achieve results that matched our guidance. I sincerely thank all our HCL techies for another resilient and an industry-leading performance. All the revenue numbers I'll be sharing today are in constant currency. In FY25, we clocked a consolidated revenue of $13.84 billion, an increase of 4.7%, attributed to both our services business and the software business. Our operating margin was 18.3%, a 7 basis points increase over FY24. FY25 marks the third consecutive year of our services business outpacing our similar sized peers. In FY25, our services business achieved a growth of 4.8%. IT and business services reported an increase of 4.6%. Engineering and R&D recorded a growth of 5.5%. HCL Software also demonstrated strong performance with a growth of 3.5%. HCL Software's annual recurring revenue now stands at $1.03 billion. This year also marks a growth acceleration in HCL Software compared to FY24. Now, getting to our fourth quarter performance, our revenues declined 0.8% sequentially, attributed to the seasonality in our software business. Software business grew 2.9%. Overall, we grew 2.9% on a year-on-year basis. Our operating margin for the quarter came in at 17.9%. Our services business grew 0.7% sequentially and 2.7% year-on-year. In terms of geographies, during the financial year, all the three geographies grew. Americas, the largest IT services market, grew 5.3%. Rest of the world followed with a 4.7% increase, and Europe grew 3.5%. Shiv will comment a little more on our geographic reporting going forward a little later. This year, our leading vertical was telecom, media, publishing, and entertainment, which exhibited a very robust growth of 43.4% in FY25. Followed by retail CPG, achieved a 10.7% increase, apart from technology and services, which grew 6.7%. Further, to capitalize on the large public sector spend, we recently established HCLTech Public Sector Solutions, a subsidiary dedicated to serving state and local governments and educational organizations, as well as federal, civilian, and defense agencies in the US. I'm glad to share that even during this period of relatively slow growth, we added 6 clients in our $50 million category and 1 in the $20 million category on a year-on-year basis. Coming to bookings, we had a very strong quarter. In fact, the second highest after the September 23 quarter, which was on back of a mega deal, which all of you know. This quarter, we brought in $3 billion in net new booking. At the fiscal year level, the total new booking stands at $9.4 billion. This strong booking was well balanced across service lines, geographies, and verticals. Our engineering and R&D services business led the charter with a record high 75% growth in bookings in FY25. This demonstrates great execution of our integrated go-to-market organization. As an example, a US-based global high-tech company selected us for a mega engineering services deal to serve the rapidly growing AI-powered silicon and software-defined vehicle segments. The client will leverage our industry-leading capabilities in the semiconductor space to bringing cutting-edge solutions to the market. With respect to our pipeline, we are very pleased with the health of our pipeline. It continues to be near all-time high, even as we experience healthy conversions in Q4. The pipeline is supported by multiple deals across IT and business services, engineering services, and HCL software business. Notably, AI and Gen AI are now integral components of almost every deal. Both Americas and Europe have shown considerable pipeline growth during the quarter. We've made significant strides in AI and Gen AI, impacting both clients and our internal operations and processes. Our four flagship offerings, AI Force, AI Foundry, AI Labs, AI Engineering, have seen substantial adoption and scaling in FY25. Our AI Labs continue to enable clients in their AI journey. They've delivered 500 AI Gen AI engagements for 400 clients. We're also driving industry-focused and horizontal repeatable solutions and investing significantly in driving agentic capabilities across our offerings, AI Force, AI Foundry, and AI Engineering. HCL Software is also adopting AI Gen AI into various aspects of its business. And most importantly, we had several instances where we are winning higher wallet share with existing customers as we bake in Gen AI induced productivity gains in our bid. We were also recognized as the world's fastest growing IT services brand in 2025 by Brand Finance, increasing our brand value by 17% year on year to $8.9 billion. We've been recognized by Ethisphere as one of the world's most ethical companies in 2025, marking the second year in a row we've earned this accolade. Looking ahead, we believe enterprises will accelerate AI adoption to enhance efficiencies and drive innovation. Generative AI has two facets. At the time of contract renewals, we expect both pricing pressures as well as new revenue opportunities. We believe discretionary spending will continue to be subdued in this environment. Geopolitical factors like tariff and deglobalization are expected to impact IT services. In the coming months, it will be an important topic to observe and monitor the ongoing development. As I look beyond the uncertain short term, I strongly believe there will be strong growth opportunities emerging out of the market uncertainties. And finally, as mentioned in our investor release, our revenue growth guidance for the full year FY26 is 2 to 5% YOY in constant currency. EBIT margin guidance continues to be at 18 to 19%. With that, I'll hand over to Shiv to provide more details on our numbers. Thank you, everyone, and over to you, Shiv.
Thank you. Good evening, everyone. Thank you for joining our Q4 financial year 25 earnings call. Let me walk you through our financial performance for the quarter first. Starting with the revenue performance, total revenue for the quarter is at rupees 30,246 crores, which is a growth of 1.2% quarter on quarter and 6.1% on a year-over-year basis. Coming to the services side, services revenue came in at rupees 27,348 crores, which is a healthy growth of 2.8% quarter on quarter and 6.1% on a year-on-year basis. Software revenue for the quarter came in at rupees 3,009 crores, which is a degrowth of 11.1% quarter on quarter due to usual seasonality, but still a very good growth of 5.9% on a year-on-year basis. Moving on to the profitability matrices for the quarter, our EBIT came in at rupees 5,442 crores at 18% of revenue, up 40 basis points year on year. On the back of seasonally strong O&D quarter of HCL Software, our EBIT grew by 6.5% quarter on quarter, and it grew 8.4% on a year-on-year basis. Net income for the quarter is at rupees 4,307 crores at 14.2% of the quarter of the revenue. Now moving on to our financial performance for the full financial year 25. Again, starting with the revenue performance. Total revenue for the year is at 117,055 crores, which is a growth of 6.5% on a year-on-year basis. Coming to the services side, services revenue came in at rupees 105,398 crores, which is a growth of 6.8% on a year-on-year basis. And I'm pleased to report that our services revenue crossed the milestone of annual revenue of 100,000 crores this year. Software revenue for the year came in at rupees 12,049 crores, which is a growth of 3.1% on a year-on-year basis. And profitability matrices for the full year, our EBIT came in at rupees 21,420 crores at 18.3% of revenue, up 8 basis points on a year-on-year basis, and our EBIT grew 7% on a year-on-year basis. Net income for the year is at 17,390 crores at 14.9% of revenue. Just an update on our return on invested capital. Our ROIC continues to improve thanks to our ongoing focus on profitability and efficient capital management. For the last 12 months, ROIC is at 37.9% for the company, which is up 411 basis points year on year. And for the services, ROIC is now at 45.5%, up 376 basis points year on year. Software also continues to improve with ROIC at 19.9%, up 370 basis points year on year. Cash generation is another highlight I would like to focus your attention on. Our cash generation remains very strong. Over the last 12 months, operating cash flow reached at rupees 22,261 crores, while free cash flow generation was at rupees 21,153 crores. The balance sheet remains strong with gross cash at rupees 30,943 crores and net cash at rupees 28,652 crores. Operating cash flow to net income conversion is healthy at 129%, and free cash flow to net income conversion is at 123%. This is on the back of our continued improvement in DSO. Our total DSO, including unbilled, is currently at 80 days, a 3 days improvement on a year basis. And now for the shareholders, our diluted EPS for the last 12 months came in at 64.09 rupees, which is a growth of 10.8% year on year. The board has declared an interim dividend of rupees 18 per share for this quarter, and the record date is 28th of April 25, and the payment date of the same shall be 6th of May 2025. That brings our last 12 months dividend payout at rupees 60 per share, effectively distributing 93.5% of our net income. That's all from my side for now, and I would like to hand over the discussion to Ram for an update on HR. Over to you, Ram.
Thank you,
Thank you
Shiv.
very much.
Good evening, everybody. This year, we increased our employee count to 223,420. For this quarter, it's a net addition of 2,665. On a full year basis, if you recall, the first quarter we had a divestiture. If we offset for that on a full year basis, the headcount increased by 3,337. So that's a net addition through the year outside of the divestiture. In terms of freshers, this quarter we added 1,805 freshers. If you recall, we made a conservative projection last quarter to add about 1,000. We've done in excess of that. That's in line with our plans that move quarter basis. So on a full year basis, the number of freshers we added for fiscal 25 is 7,829. Attrition is at 13%. That's the IT services trailing 12 months attrition at 13%. It's a 24 BPS drop from the previous quarter. If you look at last 5 quarters, attrition has pretty much sort of stabilized around 12.5 to 13%. That's on the back of the new programs and initiatives that we have launched over the last 24 months. Many of these programs are not only resonating with our employees, it also catches the attention of external professional bodies. In FY25, we received as many as 26 different acknowledgements and certifications for the type of programs that we are running, which is showing results in the way we are able to attract and retain talent within the company. CVK spoke a lot about the opportunities for AI. We have spoken about investing in AI skilling. We plan for upskilling about 50,000 of our colleagues during FY25. We significantly exceeded that target to upskill about 106,000 of our people with AI skills, i.e., being prepared to take advantage of the opportunities that come in the market. That's a quick brief. I'll pause here. We'll open the floor for questions.
Anyone question?
Yeah, hi. Hi, everyone. This is Jitendra from CM Leader. Thank you very much for sharing all the details. Looks like it's a great performance as compared to your peers. I have two questions. One with AI at center stage, and HCL is betting big on it, and of course, clients also. How do you see which are the new verticals that you see are adding more to your business in the next 1 year? Plus, in terms of your clients, which are the primary use cases HCL is solving across industry in terms of AI and agentic?
Thank you for your questions. With respect to which of the verticals are we seeing a higher growth momentum? Generally, our guidance is given at an overall company level, so I'm not providing any specific guidance by industry. But AI adoption is happening across all industries. It's pervasive across all our existing clients, new deals, all of that. Now, what are the typical use cases? We broadly classify them into 2 categories. One is service transformation, which is all the services that we deliver. How can they be delivered much more efficiently using generative AI? Right? That's where we have a platform which is a resounding success. AI Force is already deployed in about 35 customers, and we have a plan to deploy it to about 100 customers in FY26. The second theme is value stream innovation, which is in different industries. There are use cases like health clinician assistance is one example, trade surveillance is another example. There are about 100 different use cases across different industries, and we are selecting the use cases which can be repeated across multiple customers in a specific industry. So we call that as IFRS, industry-focused repeatable solutions. The second thing is horizontal solution. Like, for example, contact center transformation. How can we use generative AI to drive a faster and a much better client experience using contact center transformation? So there are similar, that solution can go across all verticals. So these are called as horizontal repeatable solutions. So these are the 2 areas we are investing in value stream innovation. That's broadly.
Hi, Annapurna from ET here. Firstly, on the guidance, your FY26 guidance is lower than the FY25 guidance, but of course, a little bit more upbeat than your peers so far. Can you explain more of your thinking on where specifically you expect to see some impact of the tariff uncertainties, etc., but also any points of optimism or what levers you're looking at to, have a better outlook than your peers? Secondly, on the AI projects, you said that there were some pricing pressures and in addition to gaining wallet share as well. Can you explain a bit more on the pricing pressures and how you've been navigating that? What have you been proposing to customers and sort of their evolving demands, what they're wanting to see from the AI solutions? And thirdly, for FY26, what are your hiring plans? Any numbers you can share?
Okay, a lot of questions. Thank you, Annapurna. Um, Tariff impact, we expect, um, we haven't seen any specific impact so far. But in terms of impact, we see this play out much faster in consumer and manufacturing segments. But if the tariff impact were to play out, I don't think any vertical will be left behind. All industries would get impacted. Uh, However, this is going to the tariff. The biggest impact will be on the costs for clients and their intention and their kind of focus on using generative AI to drive high efficiency in every aspect of their business will become the center stage of all the conversations. So we believe while there is uncertainty and there is going to be definitely a deterioration in the discretionary spend, we think AI-led efficiency is really the biggest theme where there can be large opportunities. We have a strong pipeline, and uh, while there is conservatism in the way we look at our guidance at the lower end, overall we think this is a great opportunity to create significant opportunities for us in the market. In terms of pricing pressure related to AI, obviously when you're able to deliver at a much more efficient operating levers, then obviously we share some of the benefits with our customers. So there will be a deflation due to that. But with every renewal and every client conversation, we are able to ask for a higher wallet share of their spend as we proactively provide them the benefits due to generative AI. So that's been our strategy, to be very, very proactive with our existing clients in showing the art of the possible, and in return, expect a higher wallet share. And that strategy has worked well. In fact, all the renewals that we did, 95% of them had some incremental business. That's the second question. And on hiring plans, I would request Ram to respond.
Annapurna, I guess your reference to hiring plan is for the entry-level hires. So FY26, we expect our overall numbers to be significantly higher than what we did in FY25. FY25, as I said, it's 7,829. We expect it to be significantly higher. We're going to make our plans on a quarter-on-quarter basis. We're not trying to define an annual plan. In the current climate, it's a lot more prudent to make plans quarterly. Every quarter will continue the trend of 2 to 3,000 per quarter is what we will target to go after. And that overall, on an annual basis, will be significantly higher than what we did in FY24.
Anyone else?
Hello everyone. So I wanted to ask you that, like recently HCL
Could
Tech.
you introduce yourself?
Yeah, sure. My name is Harshika and I'm from Good Returns. So I wanted to ask you that recently HCL Tech has committed about the semiconductors. So I wanted to know what are the developments on that sector and what is the progress, and is there any hiring plans for the new freshers and the uh, coming generation? And the second question is on recently HCL announced the integration with NVIDIA AI Enterprise. So could you please shed more light on that? Thanks.
Yeah. On the semiconductor program that we announced, been done by HCL Group, not HCL Technologies. So I would prefer not to comment on it. With respect to integration with NVIDIA stack, we have a platform uh, which we use for service transformation. It's called AI Force, which is what I mentioned. It's deployed across more than 30 customers. And this is a very extensible platform which can integrate any language model and any cognitive infrastructure and the language model. And we've already integrated with Microsoft, Google, Meta, IBM. We've now extended that to NVIDIA as well. This will help us to drive some industry-specific solutions using this stack, and you will hear more about it as we announce more.
Hi, CVK. Ashish from Business Standard. You spoke about a separate business solution, which is the HCLTech Public Sector Solutions. In the US, where there's a renewed demand for cutting down on public spend, and of course, the added pressure of tariffs is already there, the uncertainty is always there. Could you maybe shed more light on what's the idea behind this separate business?
So Ashish, yeah, I mean, our overall strategy is public sector is a big spend area, uh, which is more of a long-term strategy for us. And at this point, very understandable that they're cutting down on a lot of spend. But I think the biggest opportunity in public sector today is really being a challenger with for a lot of existing income. Right, there is definitely a fatigue with some of the existing providers in public sector, and our solutions, we already have a decent business within defense and public sector, and we're going to leverage that and build more around that. We think there are good opportunities if we can leverage our digital transformation and AI capabilities. We can provide a good value proposition to a lot of state and local governments and to defense. Right now, we have kind of starting with US as the base, and a lot of this execution will also happen in country.
Anyone else? Anyone?
If I may take the liberty to ask one more question. You talked about AI. I just wanted to understand that how exactly is AI is reshaping your internal AI and automation. They are reshaping your internal talent development and delivery models.
Sure. I mentioned about the investments that we are making in upskilling people. As I said, 106,000 people that we have 106,000 people that we have upskilled during this year. That's on the back of the investments that we have made. It's also about creating labs where we can put to use the skills that we are developing. Right? Today, if we look at the number of use cases that we have, both we do for our customers as well as internally, we have several use cases running, and some are in a very evolved stage where we are able to build solutions around it. If I talk about within the HR function, there's a significant solution that we have to enhance our recruiting function, both in terms of productivity and in terms of speed of execution. Right? There are several such use cases that we have across the organization. So the approach is invest in skills development, invest in labs, build use cases, and on the back of it, create POCs that we can take to customers. So that's been our approach, and that's working well so far. It's a journey, and I can talk about the experience that we've had in what we've done as projects internally as well. It takes time to scale. When you do something as a POC, it's a pilot, and we obviously learn from those pilots when we build scale. Something that is developed in a lab environment, when you have to take it to enterprise grade, there's a lot of effort that goes behind it, and there's time involved, there is money involved in it. In fact, one of the things that CVK keeps talking about is don't worry about the investments now, look at the ROIs that we can get on the back of it. And that has been our approach. It takes time, but we are seeing success.
Sure, sir. Thank you.
Hi, Rishabh here with NDTV Profit. Three questions. Firstly, on the margin profile, the guidance is below the aspirational band. Do you expect improvement in the later part of the year? Is it the macro conditions and the pricing conditions is that what is making it difficult to defend these margins? Secondly, the revenue guidance is a fairly large band, 2 to 5%. What has been baked into this? And what sort of impact of this uncertain environment are you seeing into that? Thirdly, on deals, do you expect more on the cost takeout side in terms of fresh deals? And you already answered on discretionary spending. One more on the wage hike cycle. Will you be keeping track with that?
Okay, so let me talk about revenue guidance, and then you will respond on the margins. Ram will page. Revenue guidance band, we normally give a 2% range. This time we have given 3%. This really considers the lower end of the band considers a deterioration in the macroeconomic, some of the discretionary spend worsening is what we have kind of factored in. And the higher end and mid end assumes a certain deal closures that will happen in Q1, and it still assumes some deterioration in the macroeconomic and discretionary spend environment. The higher end assumes a stable discretionary environment and certain large deals closures in Q1. That's really what we have baked in. In terms of margin guidance?
Thanks, CP. The margins, earlier this year, we announced that our focus is to deliver industry-leading revenue growth with a stable margins, and that's what we have delivered last 2 years. And other thing which we announced that our focus is we have a Project Ascent now running, which is delivering its benefits, and focus is to whatever savings we are achieving through that program is to invest in sales as well as in GenAI solution. Our immediate, that's the focus we have, and yes, we do have that aspiration for higher margin band, but at this stage, we are just focused on delivering industry-leading growth with stable margin.
On the pay increases, our increase cycle starts from the October quarter. So we're just finishing the increase cycles from the previous reviews that we did. So we'll continue with that for this year. FY26.
Shruti from Outlook Business. So as you all mentioned, that telecom segment is one of the major segment that has seen the significant growth. So I want to ask, what will be the further plan to accelerate this growth, or what will be the major issues that HCLTech is going to look into?
Yeah, I mean, overall, we've given a guidance at a company level, which is 2 to 5%, and we are not obviously breaking down with verticals. But our telecom business is a very strong business, and we have access to about 30 large telecom service providers because of the ETG acquisition that we did, which we consummated last year. So our presence is expanding, and obviously, over a period of time, that will deliver very good results. Thank you.
I just wanted to ask, in this past quarter, have you seen any project pauses or cancellations or anything like that?
No, we have not seen any cancellations in the last months. In terms of closures, there was one program which we were about to win in the last minute. It got delayed, which is a large deal. But in spite of that, we delivered one of the strongest bookings in this quarter.
I'll switch to media who've joined us virtually. So over to you, Siddharth. They'll be relaying their questions.
Thank you, Ashutosh. For our virtual attendees, please follow these instructions. If you are using the WebEx mobile app, tap the three dots on the floating panel at the bottom of your screen, then select the raise hand option. If you are on a computer and want to ask a question, click the raise hand icon at the bottom right of the participant panel and we will unmute your line. If you have joined via audio only, press star 3 to raise your hand. Our first question is for CVK from Avik Das in the chat box. CVK, he wants to know how are the financial services and life sciences businesses and manufacturing business expected to perform this year, especially with tariff threats? The second question is 2 to 5% guidance is still higher than your larger rivals, though substantially lower than your own standards. What could be the main growth levers for FY26? Third question is for Ram. Any color on hiring for FY26 in terms of freshers, and will wage hikes happen per the cycle, or would you push it back considering an uncertain macroeconomic environment?
Yeah, I think I probably don't remember the first question, but you talked about. Yeah. Okay. The impact on verticals. Uh, I think we expect to see some impact in retail, CPG, manufacturing. Those are the verticals which may see impact uh, uh, quickly once tariffs really take and get kind of executed. But this will really spill over to all other verticals. I don't think any vertical is going to be immune for the kind of situation that we have. And we believe with the growth levers, of course, we've had a very strong booking in this quarter, which also includes on a year on year, there is a 75% increase in our engineering. We expect to see a strong growth in engineering services in the next year. And in terms of verticals, of course, we've had a very strong performance in telecom. We had very strong performance in the tech vertical. They will continue to deliver good performance based on the bookings and our overall market presence. Life sciences and healthcare, we expect it to be soft because, well, tariff itself can have a certain impact on this industry, but the pharmaceutical companies are going through very client specific or industry specific challenges, and that will obviously play out and create a soft growth in the near term. That's the color that I can provide you. And
I think the other two questions were around the fresher hiring and the wage hike cycle. As I responded to the previous question, our fresher hiring in FY26, we expect it to be significantly higher than what we did in FY25. We're not looking at it as an annual number. We want to approach it on a quarter-on-quarter basis. Each quarter, we will have around 2,000 to 3,000 freshers planned for each quarter. That will take us to a full year count of a number that's going to be significantly higher than what we did this year. So that's the way we have planned for the freshers. Wage hikes, as I said, our wage cycles start from October. We're just concluding the one that we did for FY25. So for FY26, we'll start in line with our cycles. That will start from October of 2025.
Thank you, Ram. The next question is from Jas Bardia from Mint. Jas, we have unmuted your line. Please go ahead. Jas, please go ahead. We have unmuted your line.
Good evening, gents. Just two quick questions. If I look at your USD dollar growth, it's the lowest since FY21. And if you look at the lower end of your guidance, that is the 2%, that is the lowest since March 2020. Now, this seems to me that there's not just the future that you've baked in, but there's something that was probably not taken even in the last year. What was it? Second question on the new deal wins. If you look at the overall figure, it's down 5%. Why is this the case? And second, does this imply that revenue in FY26 might be lower? That would be it. Thank you.
yeah, so just I hope you are looking at what's happening in the industry. We have delivered the highest growth in the industry. So I think comparisons to 21, 22 doesn't cut any ice because we were in a very different environment. Today we are in a very different environment. We are very happy that for 3 consecutive years we've delivered the highest growth in the industry, and our objective is to deliver industry-leading growth at stable profitability. So I don't think I'm going to comment on why your growth is lower compared to whatever number of years. New deal wins is 5% lower. Yes, because last year we had a very, very large deal which contributed to a significant uptick. In spite of not having an equivalent deal this year, we have our TCV has only declined 5%. So I think it's one of the best TCVs that we've delivered in the recent years, and we're happy with it. And obviously, you know about the macro environment. We baked in some conservatism in our guidance. Thank you.
Thank you, CVK. Our next question is from Beena Parmar from Economic Times. Beena, we have unmuted your line. Please go ahead. Beena, please go ahead.
Can you hear me?
Yes, loud and clear. Please go ahead.
Just wanted to get a sense when you said the wage hike cycle is already over for FY25. Has the impact baked in already in the previous year, and how much more impact are you likely to see in Q1? On the project cancellations, just CVK, since you mentioned that you've not seen any impact, but that one project that you saw which did not get closed, could you give us some sense on how large this was, and do you see that impact continuing from your conversations with your clients? What are they saying on the whole tariff impact, and what kind of dent are you likely to see in manufacturing and consumer? And lastly, the public sector subsidiary that you opened in the US, what is the current portfolio that you hold in defense and public sector market in the US, and what sort of business have you already seen? Are you already seeing conversations? Can you give us some color on how the subsidiary has kicked off? Thank you.
Ram, why don't you take the first one and then I'll go to the rest.
I think the last year's composition cycle that we have gone through, that has been effective October and January, except for a very few in the senior management category. All others have had their composition revisions done, and that's already baked into the results that we have already announced. The residual small number that's there, that's part of the this year's projection that we have done. I don't think there's any additional impact that is there to be called out from last year.
So on project cancellation, yes, one of the programs that we were about to win, we were in the final stages. It got shelved. It's a large program, and I don't want to call out any particular number because we don't call out anything very specific. But most important is, in spite of that, we delivered a $3 billion booking in the last quarter, which is almost 45% higher than the previous quarter. Similarly, 30 to 40% higher than what we did in the same quarter last year. In terms of tariff impact by vertical, it's very difficult to quantify. I think customers will tighten their spending budgets, especially wherever ROI is not there or it's very discretionary in nature. There could be definitely an impact, and this will, while it start with manufacturing, it is going to spill over to other verticals very quickly. Very difficult to quantify the impact. Regarding the public sector solutions, our portfolio size is very, very small, but we definitely have plans to grow this, and we are seeing a lot of opportunities where we are participating, and this should start kind of growing forward.
Thank you, CVK. The next question is from Ronendra from HPL. Ronendra, we are unmuting your line. Please go ahead. Ronendra, we have unmuted your line. Please go ahead.
restrictions, would there be any impact for you on your ongoing projects? And Ram, if you could share, like, what could be the hiring plans there? Will you be hiring more locals there now as you've been doing there?
Plans, which I presume, I guess the hiring plans your reference is in the context of US, I assume. We've always been very focused on localization. If you look at the reliance on H1B, will be one of the lowest in the industry, less than 20% mark. So we already have set in motion a hiring plan that is largely localized and will continue to do that. So the reliance on H1B is going to be pretty minimal.
In terms of what kind of projects will get impacted, it's very difficult to kind of give you a view. I mean, in the last 3 months, we did not see any impact that we should really call out. But it's an evolving situation. There is definitely a lot of uncertainty around how all of this will play out and how the different companies in different industries will react. So it's something which we have to monitor and kind of plan and be very nimble. And I do believe this will also open up, create a lot of new opportunities to help our clients in their efficiency journey. And we want to be very positive in trying to look at those opportunities.
Thank you, CVK. The next question is from the line of Debangana from Money Control. Debangana, please go ahead.
Hey, hi. I have two questions. Firstly, I just saw that you have started mentioning India as a separate geography in the document that we got as compared to previous quarters, and it's degrowing on a year-on-year basis. So, firstly, wanted to understand: are there plans on doubling down on India, and what is causing this degrowth on a year-on-year basis? And secondly, wanted to understand if your peers have been talking about setting up separate GCC business units, and they are looking to expand into getting more businesses through setting up GCCs for other clients. So, how is HCLTech planning to expand on that? Thank you.
Debagna, India revenues we're calling out because India is really a big focus area for us. We have significant presence in our software business, and software business definitely peaks in December, and then in this quarter you will see a decline. Yeah, and then we don't call that out in this. And I think since it's a smaller base, even a minor change would show as a bigger percentage. So I don't want to comment on what caused the decline. But India is a big focus. We are looking at our services and software to be positioned in this market. So we'll continue to invest and grow our India business. On the GCCs, we are already present in more than 200 GCCs across the Indian landscape. And we are going to double down our focus on GCC, and you will see some new announcements in the next couple of weeks.
Thank you, CVK. The last question we have got from Shivani from Business Standard on chat. The guidance of 2 to 5% for FY26 looks stronger than what some of your peers have announced. What are the growth drivers? And the second question is, what is the impact of US tariffs on business sentiments?
I think if you look at our exit for this year, even if we don't grow in the next 4 quarters, we will still deliver a 2% growth. I think that's the lower end of our guidance. And obviously, that bakes in the fact that the environment can deteriorate and spending may become weaker than what it is. And we also have a very strong pipeline, and we had a very good booking in Q4. I think both of this gives us some confidence to drive towards a midpoint. And if we can close a couple of more large deals in Q1, which we have in our pipeline, that should also make it to be at the higher end. I think we have certain scenarios which we've kept in mind as we have planned out this year. But I mean, needless to state that the environment is very uncertain. So we have to look for the right opportunities and find ways and means to grow. Thank you.
Thank you, CVK. One last question from Prasun from PTI. What are the signals of uncertainty that are expected to impact HCL Tech's earning in FY 2026? Which are the green shoots that will help company glide through this uncertainty?
I think we have what I call as an all-weather portfolio, right? In a very strong discretionary spending environment, our digital business, our engineering services, our AI solutions, data, all of that will do very well. And in a slightly constrained environment where clients are very focused on more efficiency, then we have run the business services, which is also a very strong portfolio, which is even getting accentuated by our AI Force and other solutions that we have. So we are very proud that we have an all-weather portfolio. If you look at the last growth cycle, we delivered the highest growth in FY23, services highest growth. And in the down cycle, we've seen 2 years where we've delivered the highest growth. So we have an all-weather portfolio which will help us deliver industry-leading growth, and that's what we're working toward. With that, thank you everyone for joining and a lot of questions and interesting conversations. I look forward to talking to you during the next quarter. Thank you and have a good evening.
Thank you, everyone. Thank you. And with this, we'll now be concluding the press conference. And thank you, everyone, for your valuable time and presence. Please note that the recording of this webcast will be available on the HCL Tech website. And stay safe and take care.